Understanding cryptocurrency from cash to code. For most of history, money has meant something physical: coins, paper bills, or the numbers you see in your bank account, all controlled by governments and financial institutions. But now that's changing. You see, cryptocurrency takes money out of the physical world and transforms it into digital code. Pure information protected by something called cryptography, the science of secure communication. So, what makes that so special? Well, in the world of crypto, you don't need a bank to hold your money or a company to approve your transactions. You don't even need to prove your identity the traditional way. Here, you and only you control your funds through something called private keys. No accounts owned by others, no middlemen. It's money without permission. In a way, cryptocurrency is freedom encoded in mathematics. The core idea, decentralization. Alright, let's talk about the heart of it all, decentralization. Imagine the traditional financial system as a giant tree. There is one main trunk, that's the central bank, and from it grow all the branches, commercial banks, payment systems, and eventually us, the users. Now, imagine instead of one big tree, you have a forest, thousands of independent trees, all connected underground by their roots. That's decentralization. In this kind of system, there is no single authority calling the shots. Every participant, known as a node, keeps their own copy of the same data. If one node goes down, no problem. The rest keep running. And because of that, cryptocurrencies are transparent, resilient, and independent of traditional power structures. It's money that can't be easily shut down. How cryptocurrency works. At first, using crypto might look a lot like using online banking or PayPal. You send and receive money digitally, right? But under the hood, it's completely different. Let's break it down simply. When you send cryptocurrency, you start with a digital wallet, software that stores your keys and connects to the blockchain network. Second, you create a transaction and sign it digitally with your private key. That's your proof of ownership. Third, the transaction is then broadcast to the network. Fourth, other computers or nodes check to make sure you actually have the funds and that your signature is valid. And fifth, once verified, your transaction joins others in a block, which is added to the blockchain. And just like that, your transaction becomes part of a permanent public record. No banks, no government, no middlemen, just code, math, and consensus, keeping it all honest. The wallet, your digital bank account. Now let's talk about your crypto wallet. It's not a pouch of coins or a folder full of cash. Instead, it holds the keys that give you access to your digital money. Think of it like this. Your public key, that like your bank account number, you can share it so people can send you crypto. Your private key, that's your secret signature. It's proof that you own your funds. And if someone else gets that private key, well, they control your money. So never share it. There are two main types of wallets: hot wallets, cold wallets. Hot wallets, connected to the internet, super convenient but a bit more vulnerable. Cold wallets, stored offline, not as quick but far more secure, great for long term storage. And in crypto, there is a saying you all hear a lot: not your keys, not your coins. If someone else hold your keys like an exchange or platform, you don't truly own your crypto. The blockchain, the digital ledger. Now, all of this runs on something called the blockchain, and this is where the magic really happens. Picture a giant notebook, one that everyone in the world can see, read, and write in, but no can erase or alter. Each page in that notebook is a block, and all the pages together form the blockchain. Inside each block, you will find a list of transactions, a timestamp, a unique code called a hash, and the hash of the previous block, linking them all together. That link, that chain, is what makes it tamper proof. If anyone tried to change just one transaction, they would have to rewrite every block that came after it. And that's practically impossible. So instead of trusting people or institutions, the blockchain lets us trust math and consensus. That makes cryptocurrency a trustless system, not because it's untrustworthy, but because it doesn't need human trust to work. Mining and consensus. Now, you might be wondering, if there is no bank, who checks that the transactions are real? That's where miners and validators come in. They are like the accountants of the crypto world, but automated, distributed, and powered by code. In Bitcoin, miners use powerful computers to solve complex mathematical puzzles. The first one to solve it gets to add a new block to the chain, and as a reward, they earn newly created coins. This process is called proof of work, or POW. It keeps the network secure through computation and energy. Then there is proof of stake, or POS, used by Ethereum and many newer coins. Instead of using energy, participants take their coins as collateral to validate transactions. Both systems do the same thing. They make sure everyone agrees on the same version of truth. That agreement is what we call consensus. Transparency and anonymity. One of the most fascinating things about crypto is that it's both public and private at the same time. Every transaction that's ever happened is visible on the blockchain. Anyone can look it up. But the people behind those transactions, their real identities are hidden behind cryptographic addresses. So you get something called pseudonymity, not complete anonymity, but a level of privacy that traditional banks just don't offer. However, and this is important because the blockchain is open, law enforcement can still track suspicious activity by following the money trail. So while crypto gives you freedom, it also demands responsibility. The value of cryptocurrency. Now comes the big question. What gives cryptocurrency its value? It's not backed by gold or printed by government, so why is it worth anything at all? Well, the answer is actually similar to gold, art, or even regular money: belief and utility. Crypto has value because people believe in it, because it's useful, and because it's scarce. For example, Bitcoin has a fixed supply. Only 21 million will ever exist. It's secure, borderless, and independent. It enables powerful new technologies like decentralized finance and smart contracts. So, at its core, cryptocurrency's value comes from its usefulness and scarcity, not government approval. It's money redefined, built by code, powered by trust, and owned by the people.